What I'm looking at is what is it, let's talk about the process of financing in today's market. First off, everybody, this is Jeff Cumminsford. Jeff is Vice President of Johnson Bank. Jeff, real briefly, just if you can just share the history of how we know each other and your role.
Sure. I am in the Brookfield office. I'm what's called a field manager, so I run the residential loan division for Johnson Bank in this area, if you will. In my background, I've been 37 years in the business, and I get a chance to pick. It's kind of interesting. I get a chance to pick clients that I work with, and you're very concerned about the partnerships you have, so you're very selective on who you pick. So John and I have met a few years ago, and over time we've been referring business back and forth. So from my standpoint, I'm a manager of a big region, but I still like to originate. So I kind of selectively have taken Regency and said I'd like to be your lender. And John and I have worked on this lender for life kind of position. He wants somebody that will be around for the long term, that has the experience and has the products. So my experience in all of that has brought me to you. So, but every deal is kind of a little bit different, which is kind of fun in my business. The clients have different needs. They have different ways to consider getting the financing. So it makes it a little bit of a challenge. But your people are just extremely good. Good credit, good income, good collateral, so that makes my job much, much more easy. But it's a process. The construction lending is a little bit more complicated. I like to say it's mortgage lending 501. And a lot of customers need a little bit of insight into what's the best program. And it just doesn't start when we get them pre-approved, and it just doesn't continue when we construct the loan or construct the house. It kind of goes on for that lender for life. Most of your clients have ended up in our private banking division, so we as a bank will offer wealth and advisory and private banking services. So for us, it's a fit from the affluent client that you bring to the bank profile that Johnson Bank has.
It's kind of interesting just that you actually reminded me of how important relationships are to Regency and to us. And I remember actually sitting in the villas when we first got to know each other, and you were offering to put together some deals for us. And I remember specifically asking you, how long do you plan to be in business, what your history is, because it's vital that we wrap ourselves around people that reflect the image of convenience and professionalism, and a full-service organization that's not just interested in a quick buck. You're interested in longevity and overall value that you bring into the client.
Right. Well, your byline, if you can dream it, we can build it. And a lot of your clients will build a house and come back to you 2, 3, 4 years later. It's the same way with lending, that those clients you refer me to, we'd like to be there for them. So it's not just one house, although it could be, but it's also that position of how can we help that family in the future.
That's something that's coming around now that's been different than 3 years ago, in my opinion, is now it's recommended that we get our clients pre-approved so they know what they can afford prior to start the process, correct?
Right. It's probably more important today, the world of lending, so it's Freddie Mac, Fannie Mae, and the FHA program, basically subsidized by the federal government, has tightened the strike zone of underwriting. So what used to be a pretty easy transaction now has become burdened with a lot of restrictions. So even more important today to come on in, credit is really important in terms of lending, reserves, down payment is critical, and then the ratios. So they check to see what a family's housing payment and debt to income ratio will be, where years ago we used to have expanded ratios. Well, now they've really narrowed that down. So when we do a pre-approval, it's free, there's no cost. It takes about a day or two to get it all kind of through the process. But we play what if. What if the lot is purchased or you're going to buy it? What is the construction cost? And that's a range. If they have a house, is it been sold? Do they want to keep it and then sell it once the home is complete? what type of financing is their best. We offer, jumbo loans. We offer conventional fixed rate, construction, conversion arms. Some customers just want to get started with the lot, so we'll offer the lot financing. So the pre-approval takes it down that road, and then they can come back and say, we found a lot, instead of 200, it's 250. The construction is $1 million, now it's $1.1 million. So we change the variables and get the loan approved on that. So yeah, it's more important today to get pre-approved. No cost, it just takes a little bit of the family's time to give us income and assets and kind of move down the road.
If we had somebody that wanted to build a total package of, let's say, 800,000, lot and home combination, what kind of ranges are we talking about for down payment, and what kind of ranges are you talking about for credit score, different things like that?
So 800 would be what we call a jumbo loan. You could put as little as 10% down on a jumbo loan in the 800 range. If the package was 650 or lower, then you could put 5% down. So the loan size does have an impact on that. But 650,000 package, 5%, and then above that to $1 million would be 10%. We close, as you know, we've closed recently, I think, 3 transactions where the family has built a house in the 1.7, 1.8 million and put as little as 10% down. So we structure the loans based on the family. Real good income, real good credit scores, and we're more relaxed on that for those types of families.
Okay. Now how do we handle, because in every instance now, appraisals are becoming a challenge. It's my belief, or my understanding, what has happened is that the government may have gone a little bit over the extreme, where we were a little loose in the past. Now we're a little tight. We're too tight in the current, in my opinion.
I would agree.
So, and the scope is that we're getting random appraisers from the market that we're not used to. You don't control who you can get as an appraiser now. How do we handle the appraisal situation when we know we're going to come in under appraisal? What do we do?
Well, Johnson Bank is a little bit different. The federal government has mandated appraisals and service therein. They have what they call a code of compliance with appraising. We have selected in the metro area that we would lend for you 12 appraisal companies that have been prior approved. So we get to pick in that bucket of 12 appraisers. Now I can't pick which of one of the 12, but there's a random order to the 12. But we've hand selected the 12 companies because they know our market. Other companies, by this code of conduct appraisal, they have to go to a third party. And there are stories I've seen and heard and actually have lent to some of this where companies outside of Wisconsin are coming in to do an appraisal because of this random order to this third-party appraisal service. So the value of Johnson Bank is we've restricted it to this handful of good appraisers. Now, they have a difficult job. What's happening is there are just fewer sales out there of homes in general. And the ones that have sold have been, I'll call them distressed sales, foreclosures in some cases, or very incented sellers that have to sell for a reason. So that's pushed the value down. In your customer base, we've had affluent customers building big houses, and there are just fewer sales of those types of properties. So you combine with fewer comps and fewer sales, and they've been distressed, and the values have been coming a little bit lower. Now, you can do a second appraisal. The only problem with 2 appraisals is one might be lower, the second one might be lower than the first, and then we're forced to use the lower. So we kind of discourage that, but we have in cases said, let's do this. We've had cases where we didn't agree with the appraiser. We said, no, that value is worth, it's more than, and you've discounted too much and we need to go backwards.
How do you do that?
We selectively say comp 1 and 7 is not acceptable, get us some more comps, or exclude those, and then we'd like to go back in and use comp 2, 3, 4, 6. So we've done that. The problem with an appraiser is they're trying to use a flashlight at about 5,000 feet. So they're trying to find comparables within a mile or 2 of that house that have sold within 3 months, 6 months. The problem is they need to go to 20,000 feet today, so they're going to distances that are further away that may be comparable but may not be, and they have to go to a longer discounted sale. So I just had one where out of 6 comparables, 3 were a year ago, and the other 3 were within about 9 months. And they had to, it was a property in Slinger, and they had to go to Mequon to get comparables. So in that case, we try to look at it and say, is that still a good comparable? If it isn't, then we try to narrow that down and try to see, what does that tell us? What does it give us as indication? We're almost at the bottom of the value. I think we probably have a little bit more to go. In your world, in the jumbo kind of construction or the higher end clients, usually we can get through that. Usually, it does put pressure on the buyer to come up with maybe a little bit more money, the down payment. So instead of $100,000, they might have to put $125,000 down. So you've been pretty insulated, your customers, from that, but it's the first-time home buyers who are the problem, is because they can't come up with that additional down payment. So, but we've also worked where if an appraisal didn't work, the customer has to bring in X amount of dollars. They've come back to you and said, is there any items that we may be able to take out for short term? And we just had one where the family decided to reduce some of the cost by, let's say, $75,000. We sent it back to the appraiser, and the appraiser said, yeah, if you take out $75,000, the value will stay the same, as an example. So the customer didn't have to bring that in. Now I know, and you know, that they're going to add that back in the 6-month, 8-month construction period, but it gives them a chance not to come up with that money today. A number of those families are selling a house, and the hope is when they sell that house, they're going to get the profit and then come back in and have the cash to